Hey all, this is a brief walkthrough of the Wiley Plus assignment for Chapter 8. There's two questions. The first one shouldn't create any issues. The second one, typically students have trouble with exercises like that, so I will walk through it and the concept as well, which I'll be doing in class. So the first question, I think, is relatively straightforward. Basically it's saying we've done an inventory count. It shows we have merchandise of X dollars, in my example here, 443, and you also discovered that the following items were excluded from the 443. And then they give you a list of items that aren't included in the inventory. So basically you have to go through and say, should these be included in the inventory? If they should be, you need to add them. So you would never subtract anything because these aren't in there. But if it should be in, you're going to add it. So consignment we took in revenue, FOB, destination and shipment, again, just follow the dates and follow whether we shipped or they shipped. But essentially there's stuff in transit, and if it should be our inventory, we need to add it in. So that's 2, 3, 4, and 5, 6. The storage costs are never part of inventory, so you're not going to add that. And interest expense is not going to be part of inventory on normal payment terms. We will go through in class. There's very, very limited circumstances where you can include interest in inventory. But for your purpose here, 6 and 7, you're not going to have to do anything with. Really, it's 1 to 5, looking at the consignment rules and the FOB rules as to whether it's part of their inventory or not. And if it should be, add it in. And then the answer will be the 443 plus whatever you need to add to it. The second one is a little more cumbersome. It's talking about errors, and students typically struggle with following the logic of errors. So we've got, if I look at the first example, our December 2018 inventory has been understated. And again, watch the years in the question, read carefully. What they're asking for is the net income loss for 2019 is over or under by X dollars because of that error. And then the same thing for number 2, net income loss for 2019. And again, this is a 2019 error. And in number 3, they're just looking for the net income and loss difference. So just first off, go through this. Everything that I buy and put into inventory, at the end of the year, it's got to be one of two places. Either I've sold it, and therefore it's in cost of goods sold, or I still have it, and it's an ending inventory. So if my ending inventory is too high, by default, my cost of goods sold is too low. Now again, watch, this is ending inventory. And I believe the question part 1 is the beginning inventory is wrong. So if my ending inventory is too high and my COGS is too low, cost of goods sold is an expense. So if I have my expense is too low, then that means my net income is going to be too high. And if my income is too high, my retained earnings is too high. So these are all the same error. They just affect different accounts in different ways. So correspondingly, if my ending inventory is too low, well, that'll mean my cost of goods sold is too high. Because again, it's the same goods. I either sold them or I didn't. So if one of these numbers is too low, the other one's too high. If my cost of goods sold is too high, that means my net income is too low because I'm recording too much expense, and therefore my retained earnings is too low. The beginning inventory essentially works the opposite, and I'll go through that in class, but if my beginning inventory is too low, that means my cost of goods sold is going to be too low. I don't have enough inventory included. Again, I will go through this in class, and I've got I call it a handout. It's posted on Blackboard, but we'll walk through examples. But ending inventory and beginning inventory are two different things, and if they're too high or too low, it's going to cause different errors. So, yeah, just be careful and follow it through. If beginning inventory is too low, my cost of goods sold is going to be too low, my net income is going to be too high, and my retained earnings will be too high. If my beginning inventory is too whatever the opposite is, then it's going to flow through the other way. Just realize this same error, this error in inventory, flows and affects a bunch of different things. And I think that's really all this question was getting at, going through and what effect does this have on the various years. Again, watch the years. And then the second part, same thing. We're looking at the errors. The first part is looking at the error on the income statement. This is looking at the error on the balance sheet. Okay. So give it some thought. Try and get the answers in. But obviously, you only have a few choices. So if you get it wrong, right? If you try overstated and it's wrong, it's probably understated. If it's not understated either, then I guess it has no effect whatsoever. The dollar amount of the error is probably going to be the dollar that they've used in the question, so you can guess through it. That's it. Thanks.